welcome to Idea to IPO. Hi, my name is Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 350,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 3,500 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. I want to thank our fans for all your years of support, so thank you so much. We hold venture capital panels, legal workshops, networking events, and more. We hold an event nearly every day of the week. Check out our schedule at ideatoipo.com. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that is practical, actionable, and relevant, stuff you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley is a global aspirational ecosystem. It attracts people from all over the world who come here to do great things. Who here is not originally from Silicon Valley or the greater San Francisco Bay Area? Who here was born and raised in Silicon Valley or the greater San Francisco Bay Area? All right, well, welcome natives. So whether you were born and raised here or just arrived last night, it's important for us to provide multiple channels for you to meet people, build relationships, and grow your network. With regard to value, we want to make sure that we provide value at every one of our events, not just value for your money, which is important because we know many entrepreneurs are struggling financially. So we make sure our events are free or affordable. And if you cannot afford the cover charge for whatever reason, come talk to me and we can work something out. And at each and every one of our speaker events, we make sure that we provide a delicious buffet meal. Is that a delicious buffet meal? Okay, about 10 of you think so, but thanks for your support. I appreciate it. More importantly, though, at each and every one of our events, we want to make sure that we provide value for your time, which is your most valuable resource. Anyone here getting any younger? Besides our moderator and our panel, and maybe that young man? So when you invest your valuable time to come to our events, we want to make sure that you maximize your ROI. We have many partners that help us do what we do: law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, and lots of other players in the Silicon Valley startup ecosystem. Tonight, we're grateful to Hana House for hosting us at this beautiful venue in beautiful downtown Palo Alto. Is this a beautiful venue? So let's hear it for Colin and Hana House. Applause.
Thanks, Rob. Hey, everyone. Thank you all for coming out here tonight. This is awesome to see this many people in our space. This is our first event collaborating with Idea to IPO and Rob, so we're super excited for tonight. I hope you guys really enjoy the content. As Rob mentioned, my name's Colin. I am the head of Hana House here in Palo Alto. And just out of curiosity, how many of you have ever been to Hana House before tonight? Okay, some of you have, some of you haven't. So if you are new and you're not super familiar, we are Silicon Valley's premier flexible co-working space combined with a Blue Bottle cafe. And many of you probably don't know this, but Hana House is actually an extension of the global software company SAP, and we were actually founded back in 2015 by members of the SAP Innovation Center Network. And we were really created to become this kind of go-to workspace for the community of innovators right here in Silicon Valley. So we're right here in downtown Palo Alto. So obviously the majority of the people that come through here are entrepreneurs, investors, venture capitalists, startups. So if you want to rub shoulders with those sorts of people, or you need a meeting room every once in a while, this will be the spot to come do it. And the best part is we are a no membership based workspace. So there's no long-term commitment, no strings attached. You just pay for your workspace by the hour. You go to our website, create a profile, pay online, show up, and you're ready to work. It's that simple. So I really encourage you all to come check us out outside of an event like this during our business hours. I'm here almost every day of the week. If you come up to the front desk, ask for me, I'll come out and buy you a Blue Bottle coffee My treat, I promise. Once again, my name's Colin. I'll be walking around tonight. Feel free to come up and say hi. We also have our haunted house booth here in the back right corner, so you can come learn more as well. I'll hand it back to Rob now.
Thank you, Colin. A few of our other partners are here tonight. I would also like to have them say a few words. Let's hear it for Roger and Procopio. A few words to say?
You know, we get paid by the word, so we speak a lot. No, I'm kidding. I'm sorry for the clients that are here. That's not true. Absolutely. So, as Rob said, my name is Roger Rappoport. I am a partner at Procopio. I head up our emerging growth and venture capital practice group. It's a full-service firm, AmLaw 200, 300 lawyers. We have 27 different practice groups. IP is the one that I lean on most for my emerging growth clients. Before becoming a lawyer, I was an entrepreneur for 10 years, sold my company, and didn't have the multi-generational wealth-creating exit that I should have after 10 years. So just do everything that I didn't do, or do everything that I did, and you'll be fine.
All right, well, thank you, Roger. A few of our other partners are here. I'm also going to have them say a few words. So let's hear it for Wallace and Metis. Applause.
Hey, Hannah House, Wallace from Metis. I own Metis Real Estate. We're a bunch of real estate geeks selling real estate. So if you need help with residential real estate, commercial, or you need to buy and lease for your next big startup, we're happy to help you. Reach out to us, and we'll see you after.
All right, next up we have Quarantine from Orca. Applause.
Thanks, Rob. Hello, everyone. My name is Conor. I'm from Orca. If you are a founder, a non-technical founder, and you want to create an app, or you already have a team and you want to build your product faster, Orca offers unique bespoke app development services with a team as a service model, and we are here to help you. Happy to talk to you. Thanks. Bye.
All right, next up we have Sonal from Graham Adair. Applause.
Hi everyone. I'm an attorney from law firm of Graham Adair Inc. We are a business immigration firm helping employers navigate ins and outs of immigration law. If you have any questions related to immigration for your employees, for yourself, any work-related, work authorization-related questions, reach out to us. My colleague Liseji Dressler and I will be there to answer any questions. Thanks.
All right, next up we have Cynthia from Carr Consulting. Applause, Cynthia.
Hi, I'm Cynthia. I do personal brand marketing, so if you need help with your resume, LinkedIn, board bios, things like that. And I'm doing a little contest, which is better, Reese's or Kit Kats, so come over. Right now, Reese's is winning, so if you want to go with Kit Kats, you better come over fast. Thank you.
All right, last but not least, we have Frankie and Sushi from New York Life. Applause.
Hi, everybody. How y'all doing? Woo! My name is Frankie, and this is Sushi. This is my business partner. And so any founders here looking for funding? Anybody? Woo! Awesome. All right, in order to get funding, many VCs require that the people have life insurance, and so I can help you at that booth right over there. And then if you guys can guess Sushi's age, I'll give you guys a free business card. Thank you so much for your precious time.
So though our local mission is to support entrepreneurs here in Silicon Valley, our global mission is to democratize entrepreneurship and innovation all around the world. To that end, we maintain a robust YouTube channel, youtube.com/idea to IPO. Check it out. We have tons of videos there, and this rich, valuable content is available on demand, anytime, anywhere, totally free of charge. Our partner in this endeavor is Tim Jeggers, one of the top professional videographers and digital marketing experts in Silicon Valley. Let's hear it for Tim.
Thank you, Rob. Thank you, everybody. So I'm Tim. I'm the video partner for ID at IPO. I've been doing work with Rob for several years now. I run my own company. I've got a small team of maybe like 4 or 5 other people. We do some full production size stuff. I do a lot of smaller stuff like this by myself. I also do a lot of other multimedia, but video is my emphasis. So if you have any questions about that or just want to know anything about what I do, I'm in the back by the video cameras. Should be fairly easy to find me if you have questions. And thanks for having us. I'm going to go ahead and give it back to Rob.
So here's the schedule for the rest of the evening. Our panel will hold a brilliant, compelling, dynamic, entertaining, and scintillating discussion. Right? No pressure. We have high standards at Idea at IPO. We'll open it up to audience questions at about 8:30 p.m. That'll take us to 9 p.m. We'll end the program, stick around, network, socialize, and connect. As a courtesy to Hana House, we'd like to leave the building by 9:30 p.m. However, there is an after party, and these are the 3 options. The Rosewood, I know it's Thursday night, the patio, and Pizza My Heart. So more on that later. So without further ado, I'm going to hand it off to our distinguished moderator, Roger Rappoport, partner at Procopio. So let's hear for Roger and our panel.
Welcome, everybody. Hopefully, this will be as scintillating as Rob hopes it will be, and you'll get something out of this. I just want to introduce the panel really quickly. We've got, to my left, Jennifer Vancini, managing partner at Mighty Capital. We've got Conor Riley, an angel investor, LP and principal at Global Capital Markets. We've then got Zoe Samuel, venture partner at Starshot Capital, and everybody knows Bill Reichert at Pegasus Ventures. So maybe we could just go down the panel. We'll start with you, Jennifer. Just give us a little bit of your background and tell us a little bit about what you're doing.
Thank you. A quick correction. I'm general partner of Mighty Capital. My managing partner, some of you have probably met, Estee Moati. She and I co-founded the firm. Well, it's been about 6 years, and in those 6 years, we've had 3 IPOs, 3 other exits, actually 4. We're finishing one this week. And we're on our 3rd fund. We invest primarily in B2B tech at the Series A stage. What makes us unique is that we have a global platform of more than 300,000 product professionals that we're able to leverage for our portfolio companies as they scale to sell more product, hire product talent in particular, and meet exit partners. So we work closely with that organization to get signals from the market about what are the trends in product, what products do product managers themselves love and buy and champion. And then we work with the executives as chief product officers to understand where that means for strategy for large organizations, M&A, and the whole cycle from innovation product up to exit. So that's a bit about Mighty Capital.
And just in terms of stage, early stage and check size?
Sorry, I didn't cover that, did I? Yeah, so we're Series A is our sweet spot where there's been initial product market fit. And I say initial because that is a point in time that changes constantly. Product market fit's a bit of a myth because it's always changing. But initial product market fit and traction from the customer so we can hear the voice of the customer that says, yes, this product is adding real business value. I'm putting money down for it. I plan to expand my commitment to this company. So starting to see growth. So we put in early growth capital in the form of $1 to $5 million. If we're leading, we'll be on the higher end with some of our co-investors. But typically a $1 million-ish check at Series A, and we can lead, co-lead, or participate.
Conor.
Hey everybody, I'm Conor Riley. I'm an active angel investor. I'm a partner at Odyssey Ventures, which is an early stage tech focused fund. I'm a partner at Western Brand Group, which is a late stage consumer focused fund that I'm really excited about. I like to sail. I ran a bunch of different private equity funds prior to the 3 projects that I'm associated with now. And I really love this area, and I'm so happy to see all these entrepreneurs here ready to have a great night.
And what's your sweet spot?
Well, because I'm in Like the consumer-focused one, though, that's sort of controlled deployments. So we're looking at really late-stage things that we can take a significant ownership stake in, and that's later stage in the life cycle. So checks in that area range everything as small as like $5 million all the way up to 20, 25 million, depending on the project. For the Odyssey Ventures, that's somewhere between $5 and $8 million deployments. And then in my angel activities, I generally try to put in between 50 and 500,000.
Great. Thank you. Zoe.
Hi. Oh, yep, it's working. So I'm Zoe Samuel. I'm at Starshot Capital, formerly Google. And we are a clean tech fund that we just raised our first fund, and we're investing in early stage, so seed and Series A climate companies that are in the built environment, the industrial sector, and the food and ag land use areas, because we feel that energy and mobility are very well served, which we're very relieved about. And part of our typical check size will be 500,000 for the first, but then we do follow-on capital, and we do like to occasionally lead a round. We've only done 6 investments so far, so we have lots more still to come. And part of our secret sauce is that the general partner and one of the other partners are the chair and vice chair of Work on Climate, the biggest community for technical climate folks across Silicon Valley, which, if you're not a member, 22,000 members so far. And I co-created the biggest climate solutions group at Google. So we have the sort of very good network among people who, as we like to say, were cooling the planet before it was cool.
Excellent. Thank you.
I'm not sorry.
Bill. Thank you, Zoe. Bill, tell us about yourself.
Thank you so much. And, Rob, once again, spectacular job of pulling the crowd together. It is, and I still haven't quite gotten used to getting together in person again. It's just so cool, isn't it? I mean, aren't you guys glad to be together again, right? And thanks to Hana House as well. So again, my name is Bill Reichert, and I'm a managing general partner at Pegasus Tech Ventures. Pegasus is a global venture capital firm. We've got over $2 billion of assets under management. But we have a very different model than your typical venture firm. Almost all of our money comes from multinational corporations that have given us funds to find emerging technologies that are of strategic relevance to them. So we've got over 30 plus multinationals who are LPs. We go out scanning the globe looking for these emerging technologies that could be of interest. It turns out across all of these companies, across all these geographies, we invest in pretty much everything, in pretty much every stage, in a lot of different geographies. And I hesitate to say that because the result is that people say, "Oh, then Bill, you must want to invest in my company." I'm sorry, but it won't always happen. I'll try. But we're investors in space tech. We're investors in SpaceX. We invest in quantum. We're probably one of the most prolific investors in quantum computing, hardware and software. We invest in 23andMe, we invest in genomics, smart health tech, we invest in material science, we invest in climate tech, clean tech, we invest in consumer, we're investors in the world's most indestructible hosiery and tights,
Very exciting.
Company called SRTX. Everybody, go out and buy the world's most indestructible hosiery and tights, SRTS, SheerTex.
If they're indestructible, then they're more sustainable. So.
And guess what? Great sustainability angle because they're indestructible, lower plastic, you don't throw them away. Good point. Thank you for helping me out there, Zoe. So, in any case, and we are the creators and sponsors of one of the world's biggest and most and richest startup competitions. Everybody know which one that is? It's called Startup World Cup. Does everybody know Startup World Cup? Please tell me you all know Startup World Cup. If you don't know Startup World Cup, go to startupworldcup.io, and our Silicon Valley regional competition is August 3rd. I think we've just opened applications. So apply to compete on stage, Computer History Museum, Silicon Valley, August 3rd. The winner of that competition goes to the grand finale with an opportunity to win a $1 million grand prize. And then I'm going to hand it over to Nuno, who's one of our judges sometimes, right? Okay. Thank you.
Thank you, Bill. Nuno.
My name is Nuno. I probably have the coolest name on the stage, if you don't mind me saying so. And my claim to fame is one person once came to me and said, "Oh, you're just like the Teletubby." Apparently there's a Nuno vacuum cleaner on Teletubbies for those who have kids, etc. Not written the same way, but apparently that's my claim to fame. I'm the managing partner and founder of Chamaeleon. We're an early stage VC firm. We're actually a global firm. We're based here in the Bay Area, but we actually have offices in Europe as well. Has anyone watched Moneyball, the movie? Okay. We're Moneyball for venture capital. So one of our claims to fame is we use quantitative methodologies, AI techniques, and algos, as well as technology that we build in-house to develop our own platform that helps us throughout our process, from deal sourcing, due diligence, all the way to portfolio management. If that sounds different, it's because it is actually different. We're sort of trying to recreate the Renaissance technologies moment for hedge funds into venture capital. I've been doing this for 13 years. At Chamaeleon, we do early stage, so Series C, Series A, $1 to $5 million checks. We're a bit contrarian. We don't just follow trends. We use technology ourselves, which is also contrarian in and of itself. And my claims to fame, I've been, as I mentioned, 13 years in this industry as an entrepreneur in venture capital. Pro tip, don't become an entrepreneur in venture capital. Probably the worst type of entrepreneurship that you'll ever see. A bit like masochism in some ways. But I've been very blessed to have invested in companies like DraftKings, Robinhood, Verta Health, Gusto, Rubrik, App Annie, companies that you probably have heard about. I also have a podcast called Tech Deciphered, decipheredshow.com, with the co-founder and former CEO of App Annie, Bertrand Schmidt. So you guys should listen to that. That's now a top 3% podcast globally. And finally, I do a variety of other things in my life which really don't matter that much. I also have a very cute dog. I should have brought her. I've been in this industry as of this week for 27 years in technology, which is really, really silly. I'm not that old, by the way. I started very young, I guess. So background as a computer engineer, I wasn't a 10x person, so I became an engineering manager, then became a product manager. I still am a product manager today, which is really, really cool. And my mid-career, I was really a growth operator. I've lived at least in 10 different countries and have worked, as of last count, in 35 different countries. So looking forward to tonight.
And Nuno, do you lead or do you follow with your investments with Chamaeleon?
If it's Series C, we normally lead or co-lead. We don't have very sharp elbows. If it's Series A, we're normally what we call a value-add co-investor. So we won't come in just for the sake of it. I forgot to say this. This is another part where we're contrarians. We're a generalist fund, but we specialize around the partnership and we specialize around our engine as well. So we're sort of like the best of both worlds, generalist and specialized. I mostly do these days consumer, physical, and software, as well as horizontal software as a service. So things that would work across different industries with very little adaptation. Think Gusto, for example, like HR management systems, etc. But I've done a lot of deep tech, frontier tech. You probably have seen me in a variety of, robotics panels in the past and AI. One of my partners is now more focused on that. We do vertical SaaS, Industry 4.0, IoT, and a variety of others, as well as blockchain as well.
Great. Thank you. It only took a few minutes and for Nuno to mention AI, which kind of shocked me that we didn't hear AI beforehand. So this question is to the panel, and putting Gen AI aside for the moment, so if we could just not touch on Gen AI, just for the panel, how would you describe the venture investment landscape for the first half of 23, and what are you thinking for the second half of 23, and maybe even into the first quarter of 24? What are your thoughts?
Well, what I'm seeing out there is I'm seeing a lot of deal flow, a lot of opportunities, and I think that one of the things that VCs are looking at is making sure that they're getting in at the right valuation. So as valuations have shifted, I think it's necessary for VCs to take a more disciplined approach in their deployment. And so I think that really changes the landscape because it means that there are fewer deployments, fewer investments being made, longer deal cycles, much more emphasis on the underpinnings of the business. And I don't see that changing as we kind of ride out the next 18 months or so.
Do you think 23 is the year that we see the bottom, we find the bottom?
I don't know that there's necessarily a bottom per se, because deals that do have great fundamentals are highly sought after. So there's still firms that will pay a premium if they feel like there's a deal that meets their risk profile. So I don't know that there's necessarily a bottom here. I think that the economy won't really recover for another 2 years. And I think funds are realizing that their relationships with their LPs are changing. And so there's a much more sort of risk-averse approach in deploying capital. And I think that's going to be around for another 2 years.
So do you think the deal volume and deal value is going to remain sort of constant for the next 2 years before it starts picking up?
I think people are getting a little bit more comfortable working in this environment, and there's still good deals to be had, and there's still great opportunities. And I think that everybody on this panel is talking about value add deployments of capital. So what you're seeing is I'm going to write a check, and I'm also going to implement these operational controls and help with these strategic partnerships so that we can mitigate the risk and really grow the business in the market. And I think that that's actually going to help sort of increase the acceleration of deployment and really give entrepreneurs what they need beyond just capital.
If I can just jump in while I still have a voice. 2 points. One is the world was in a space where entrepreneurs had a lot of control and a lot to say. We had a lot of party rounds, a lot of rounds that entrepreneurs said, okay, this is the valuation, you guys come in, right? And that lasted for a very long time. We're in a very long bull market in general, in equities, not just public equities, but also in private equities, which is the world we belong to. That's gone. And it's going to take a while to come back. So now we're going to the other part of the cycle where we, the investors, have more control. And so from the perspective of what we were just sharing in the panel, definitely, for value-add investors, people that have capital to deploy, who can easily call capital from their limited partners, we'll come back to that in just a second. This is a great time to be in the market. It's a great time to be an investor. We're about to close 2 deals in the next few weeks. We'll get great valuations. I think we were pretty disciplined as a firm through the bubble, but at the same time, this is a great moment to be in the market. The second piece, which is more nuanced and more complex, is you need to understand, some of you here are entrepreneurs, you need to understand who do we report to. We mostly operate funds, and funds, the money are put in those funds are put by limited partners, our investors. We also need to fundraise. That's why I was making the joke that we're sort of like masochists, because our fundraising processes take years in general. What's happening is some of these limited partners are like, wait a second, right? You guys are deploying capital way too fast. I want to see how you're looking at the valuations of your portfolio companies right now. You should reassess your valuations right now. Maybe I actually want you to slow down your pace of deploying capital. We personally, as a firm, are not in that position, but we see a lot of funds and firms in that position. And when that happens, it means that some VC firms will actually slow down their pace of investment for a while. So again, it's a good market to be an investor. The nuance of this is at the same time, limited partners, who are the people that we behold to in some ways, are in some cases saying you need to slow down a little bit and I need to see how the market's actually panning out, because basically we are still in the middle of a crisis.
I want to also add that when you're in climate, we do not have 2 years to waste in climate. If we sit on our ass for 2 years waiting for the economy to decide that it cares about the fact that the planet's on fire, a lot of people's lives are going to be ruined. So there are huge tailwinds in climate as well. Like, it's finally understood that it's serious business. And then, of course, there's the Inflation Reduction Act. There's regulatory change happening. Pretty much every big bloc in the world, the EU is doing all this stuff as well. Sunak and Biden were at the White House literally today talking about making sure that the UK gets to be involved in parts of the Inflation Reduction Act despite not having a trade deal. So it's nice to see both my homelands being sensible today. And then, of course, there's the war in Ukraine. It's now very patriotic in Europe to get off natural gas and oil. And I think as the geopolitics of the world changes over the next couple of years, it will become increasingly important. The energy independence is going to be more and more of a buzzword, and it's increasingly important. You'll be able to get a lot broader swath of people. It won't just be sort of hippies and scientists caring about climate. So if you are someone who can keep calm and carry on in an economy that is feeling a bit wibbly, then there's still a huge amount of opportunity in climate, and there's a really strong sense of urgency. So we're not going to be waiting around. We're still doing stuff.
So can I strongly agree with my colleague here and disagree with my colleague here? So, first of all,
It's the right
First
way
of all,
around.
Yeah, that's all right. There we go. Okay, well, and first of all, and remember everybody, mind the gap, right? Mind the gap. Sorry. But yes, but to Nuno, you know, it's weird because entrepreneurs, you know, we do these macro discussions and ooh, it's booming and everything's great, and so presumably you should all be happy, or oh, it's slowing down and you know, blah blah, and you should all be anxious, but you guys don't care about the macro. I mean, maybe at the margin, but I will tell you, it is so hard. It was so hard to raise money as a startup company, you know, 3 years ago. It was a little bit easier, but you know, it's still hard to raise money as a startup, as an entrepreneur. I mean, you read the paper and money was gushing 3 years ago. Money is still gushing. Money is still gushing by any measure. Money is still gushing. There's plenty of money out there. And admittedly, right, the LPs are getting a little anxious. But the issue for you is not the macro. The issue is for you guys is finding your lane, because everybody up here is still investing. And you know, we are not slowing down at all. Now, we are being a little more cautious, and we're loving the fact that
bar
we
is much
can,
higher, Bill.
You know,
Much higher bar.
It is much higher. But so the point is simply, there's still plenty of investing going on. And so the problem was, it was easy to find a lane to find money last time. It's harder to find a lane, but there are lanes that you can find, like climate tech. If you can find something that is unique and compelling, you can get funding. It may not be at the multiples that people used to give you, and it may not be the dollar amounts, and you may have to have your act together a little bit more, but that's the point here. Don't get driven by the macro numbers. Get focused in finding the right investors, finding the lane, finding your compelling value proposition, and making sure you focus on finding the right investors.
So you're agreeing with me, basically.
I guess so.
All right. I'm going to go last, which is easiest because I can just agree with pretty much everything that was said here. Maybe if it's valuable, what I'll add is the nature of the deals that are coming to our desk. We see 4,000 opportunities a year. It hasn't slowed down through any of this. I would say 75% of the time there's still a big misalignment on valuation. And maybe I'm being generous when I say, right? And on how much money should be raised. We're Series A investors, but a lot of what we're seeing is not a priced round. It's, I'm going to open up my last round. I'm going to extend my seed. I'm going to do $30 million in convertible notes. I'm really just, don't want to do the next priced round yet until the market's ready. So all these extensions. Oh, and I want my last valuation. Even though, I've faced some headwinds and I didn't cut my burn rate fast enough. So people still trying to extend that runway. And as the months have gone on, there are companies feeling the heat, getting pretty desperate. On the flip side, at Q1, Q4 last year, nobody wanted to go out and say, okay, I'm going to raise a new Series A. Some companies did. We did participate in a good Series A for a cybersecurity company that met all the fundamental metrics, had the value proposition, whatever. So it was a classic Series A, but most companies said, I'm going to wait to raise that A till the market's ready for me in Q3, Q4. Well, now they're starting to come back and say, I'm going to raise my $10 million Series A at the same valuation expectations I would have had 2 years ago, and I have $400K in ARR. They're not raising. They're not getting their term sheets. Inevitably, we'll be like, okay, everything else is kind of interesting, but this is a sticky point, and we'd like to see more traction. So we can just wait, follow them, build rapport, try to help them out. 9 times out of 10, a month later, they come back to us and say, well, what if I raised half as much at half the valuation? So that's still a lot of what we're seeing. I'm hoping that this washes out through the end of the year. Hope it's earlier, and that we get back to more of a regular cadence of proper rounds, proper price rounds. But there's still a big washing out that's happening. And so it's definitely beneficial to be on the earlier stage of the spectrum, where you haven't messed up your cap table yet, you haven't burned through $40 million in investor funds, and now are out with your hand out so you can make payroll in 2 weeks. So that's what I've seen this year in the landscape.
Great, thank you.
Could I just kind of elaborating on that and some of the thoughts that the panel shared. especially Bill's thoughts of let's get away from the macro and look at the micro and look how this impacts. So pro tip, don't make a desperate deal with an investor. If we see full ratchet anti-dilution for Uncle so-and-so on the cap table, it's a no-go. Raise your money. Don't get married to a valuation. Valuations are all bullshit, especially at this phase. You're building a strategic capital plan with your capital partners. So the best thing to do is say, hey, VC, you see a lot of deal flow in this area. Given my business dynamics, what do you think the valuation really is? And then work from there and start working backwards from whatever the number is for that $100 million round at the 70, or whatever the crazy round is in the future. But treat these as rational early stage discussions because that's all they are. And if you do that, there's lots of money that's available. So keep your cool, don't do crazy terms, have a good attorney that's advising you, you'll be fine.
So the takeaway here is stay calm. Stay calm, build a big, beautiful business. So I'm impressed with the panel. Everybody has resisted the urge to mention AI, and in particularly Gen AI. It seems like every conversation in the Valley begins with or ends with Gen AI. It's quite phenomenal. And I agree with the panelists in terms of funding the environment. But with Gen AI, it just seems to be completely different. It seems like, I was here in '97, and it kind of feels like that. It kind of feels like this Web 2.0, but on steroids. Everybody's talking about it. People are doing it. I'm seeing clients with incredible term sheets and, really, really top-tier VCs that are fighting to get in the deals. So with this rapid advancement of technology, such as Gen AI, how do you assess the potential impact of those opportunities on your opportunities? How are you assessing it with your deals?
If we go back, something happened in 2008. There was a company that launched an app store. And at that point in time, when they launched the app store, everyone's like, oh, cool, these are very cool gadgety thingies that we can use on our phones. And at that point in time, several of us said, actually, maybe that's going to be a new thing. There's going to be mobile app first things out there, mobile first things out there. And now we talk about app economy as it is a fait accompli when it wasn't, right? People called me dumbass in 2009 when I talked about app economy. Who's a dumbass now, I guess. Generative AI for me, the best analogy I have for it is it's a new app economy. There's leading platforms out there, open sourced. We have OpenAI, which is not really open, by the way. So there's open source, there's OpenAI. We have Google obviously going for this. So there's like major players that have developed amazing platforms around this. And there's a lot of innovation happening around it right now. The way we think about it, besides all the transformational stuff that's still going to happen around artificial intelligence, and there's much stuff to come, is when we talk about a lot of these plays on Gen AI, they actually are apps, right? And the problem with apps is who's going to win, who's not. It's very noisy, like it was with Apple and with then Google Play. It's very noisy, but we will have plays that will be AI first, and they will actually conquer some market. So that, I think, is the very big complexity for us as venture capitalists. It's the complexity of reducing the noise and really figuring out who has a shot at winning or not. Secondly, and this is my pet peeve, but I'm going to leave it here today, I don't know who came up with the whole generative thing, the name. I'm sure it was some engineer at some point in some place when they were doing neural networks, and they're like, oh, let's call it generative, right? Let's, call it generative, pre-trained transformers. I mean, cool, GPT, yeah. It's actually not really generative from the perspective of what we understand as generative. That's why there's now lawsuits and stuff out there. It's actually aggregative in some ways or cumulative, right? And so, as Jeff Hinton was saying, we also have to be a little bit careful with what we're seeing, because a lot of this will promote even more fake information and even more stuff that is actually not rooted in anything factually correct, because that's actually how the algorithms are working, right? They're just putting stuff next to each other that makes sense, but it's not necessarily accurate, okay? So that's my pet peeve, and that's our view, at least as a firm, very noisy, but really excited about what's happening.
I worked on Lambda, now Google Bard, and I'm one of the folks that helped train it. My job was to try and get it to do and say naughty things that it shouldn't do. and because I came from a showbiz background, they were like, I bet you can get it to do something horrible. The fact that, you may all recall a gentleman named Blake Lemoine who last summer, a Google engineer, blew up his own career by saying this thing is sentient, and a free lambda was trending on Twitter back when Twitter was still important. No, oh gosh, I'm in trouble now. They're going to come for me online. I think that the problem with it is that, as you point out, it's not generative. It's rolling a billion-sided dice, and it's weighted dice. And I think that the mother and father of all copyright infringements may be claimed. I don't know if it's going to stand up, but I think that there's going to be a lot of trouble. If you look at the WGA strike in Hollywood, there's going to be, someone's going to try to reverse engineer, how do I tell what was fed into this given model? Did they feed everything from the Atlantic magazine? And if in that case, do I now owe the Atlantic money? And I think people need to really start figuring out some of those questions, because this is not creating new stuff yet. From what we can sort of see, what's publicly available now. I'm not going to speak about what's behind the scenes. And it's not it's not magic, it's not sentient yet. And I think that we need to really have someone come along and figure out sort of what are the implications for ownership, for IP, for art, and for copyright, because otherwise we're going to land in a world of hurt, and we're going to destroy we're going to mess with large parts of our culture that we really like and that are some of the most valuable things out there.
So if I may, I just, I find myself in a difficult position of wanting to agree with Nuno here. And I think it's an interesting thing that might be happening here, because I thought I was going to be radical and say, generative AI is wildly overhyped. And it sounds like you all agree. I mean, it sounds like that, which is pretty interesting.
Someone's going to make $1 trillion from it, but, not.
Right. So it's, it's way overhyped on the one hand, but on the other hand, as Nuno says, it doesn't mean it's not an interesting platform for making an interesting application. But it's, it reminds me of, boy, I'm going to date myself now, but back in the olden days, believe it or not, people thought that when multimedia came along, that was the next big thing. And if all you had to do was say multimedia, and VCs would invest in you, right? But no, right? What are you going to build using multimedia? What are you going to build using these tools that are generative AI, that are kind of way overhyped in terms of what they can really accomplish?
What problem does it solve in your life? That's the key thing. And obviously, everyone here has drudgery in their life that needs to be gotten rid of, and it's eventually going to start solving that. It'll do all of your grocery ordering and all that kind of stuff for you. But
knock my socks off! Wow.
Do
all my grocery ordering? Are you kidding me?
Yeah, exactly. It's like,
wow, my life is transformed.
Until once it's embodied and it can put it in the fridge and cook it, then we have, Exactly.
Right. No, but it's a fair point. It's a fair point. A lot of these niches, people can build something that who would have thought you could build a unicorn by promising to deliver food, right? I mean, so, there's business out there to be had, but don't overestimate, that one, you've missed the wave because you're not OpenAI, or two, that somehow just saying generative AI means that people are going to fund you.
Yeah, I mean, I can't agree more. What we're seeing now with people that have embraced this AI situation, it's very similar to something we saw in the cosmetic business with CBD oil. Or retinol. Think of retinol. Retinol suddenly was in everything. Everyone's using it. You can try retinol or argan oil or any of this stuff.
Acai berries.
Yeah, yes. It's insanity. So what people are doing is they say, oh, AI, this is an interesting thing. My business is a fitness trainer on an app with a camera. Oh, but it's got AI in it. So, So the key thing to look at, if your business model is not built around AI, if you're not an AI business, you are not an AI business. Look at the thing that your revenue is doing. That's the only thing any of us care about. So if you build out a business that's making money doing anything, resist the urge to plug in AI so you can put it on the slide deck. Yeah. We don't care.
And we're going to know you're not really using it to add value.
Right, exactly.
It's springboarding on the cosmetic thing. Even though we're only in the second inning of this ball game, and it does feel like 95 with the internet, 2008 with mobile, it's more of a shift even than blockchain was 2 years ago and how that was on every slide. But we're already seeing commoditization of AI. So now it becomes like, how can you really use it in your real core product to drive revenue, reduce costs, automate, improve productivity? But companies that are an AI company, AI SaaS platform, they're having a lot of trouble, from what I've seen, generating repeatable SaaS revenue, which VCs love to see. And when you dig under the covers, it's a lot of services, a lot of project-based revenue. Now, you can have a fantastic firm doing that, but it may not be appropriate for VC funding. So it's interesting. I think it's already commoditizing.
It's basically the Macarena of the tech world.
Right, even though it's really hard to do, you know, and then I was in the encryption business in the late 90s, really hard to build those algorithms. It became a cheap ingredient real fast that had to go into everything. So
I think the TLDR is that there's no substitute for substance.
Yeah. So I know we've got sort of limited time, and there's so many questions I still would like to ask, but we're not going to get to everything. So just in terms of what you folks are seeing, emerging trends, emerging sectors, things that are looking like they're getting hot besides AI, and are there any sectors or any areas that are becoming less and less attractive to investors?
Climate is hot in both senses.
A double entendre, right?
I'm sorry. I'm going to keep doing it. And crypto seems a lot less cool than it was, which I'm fine with because I'm, not laundering money.
I think one area that's really hot right now is logistics and fulfillment. We've seen Amazon just go, gangbusters over the pandemic, and now that we're on the other side of the pandemic, everyone's looking at those costs. Whenever you buy anything from a consumer-facing business, it costs about 20 to 24% of their top line to fulfill that order, and with new technology, that's coming down to 10 to 15. More profitability for those companies and a great opportunity to leverage technology and move in boxes.
Automation, anything that reduces costs and increases productivity, and it's hard not to talk about that without talking about AI, because there are significant use cases there, but we're seeing a lot of potential there. We have one particular portfolio company whose revenue is going like that by automating customer service through chat, a company called Game On. So we're seeing that area hot, yeah.
And a couple of areas not generally discussed in VC panels are material science, which bleeds over into climate tech in a lot of ways. But again, you understand my bias is our corporations are interested in emerging technologies, and a lot of corporations, they actually make things. And so they care a lot about, advances in material science, chemistry and biochemistry. Some really interesting things happening there, which bleeds over then into life science. We had this really interesting tailwind wave that happened with COVID in the life science space, and then there was this kind of pause, and now we're seeing sort of lots and lots and lots of research that is bubbling back up, and the intersection between the science of life science and the business of healthcare is huge, huge. So that's just a huge wave going forward. In terms of sectors that are on the down, investing in unicorns, I think that's
I'd say.
A lot of hot things have already been mentioned. My leitmotif, I spend a lot of time around consumer. We're at the verge of maybe 3 fundamental shifts in demographics. Gen Zers, who are very different from millennials. Seniors, the first senior population that is fully digitally educated. They don't need to count on their kids to buy them stuff and set up stuff, right? They can just buy whatever they want, which is cool. And then the alphas, right? We're coming next, and the alphas are just scary, honestly. I've friends of mine who have kids who are 13 who are doing businesses and are asking, their parents, like, can you help me set up my LLC in Delaware? I'm like, what the hell's going on, right? You're 13. So, and then they do it themselves because their parents are like, it's too expensive. They're like, oh, I took it off the internet. Can we just use this one? True story, actually. We're very interesting also on the trough of disillusionment stuff. I think our industry is too lemming-like. We follow every other VC firm. We look at the top VC firms that have a lot of assets under management. And we follow a lot of signals based on what others do and invest in. There's a couple of areas that I'm excited about. I'm not sure if we're going to invest in it or not, but I think they might be at the right point for us to think about it. AR, VR, input and output needs to change. These things are BS, right? Now, I don't know if it's Apple Vision Pro that's going to untap all the stuff, whatever, maybe not. But actually, there's something there, and we're probably at the right time to really think through that. The self-driving stuff that obviously was overhyped for so many years. Maybe there's now interesting plays around that architecture, not full on, competing against Waymo or Cruise, but there might be some interesting things happening right now. So we are a little bit contrarian, as I said. So we don't only look at the hot stuff, and we don't only do top-down analysis and stuff. Like we've spent a lot of time looking at consumer, for example, and figuring through what's latent demand look like in consumer. But more importantly, what are the things that actually have to happen, which we now believe are not going to happen because too much money has gone into it. And that might be an exciting space to spend time on if I was an entrepreneur at this stage.
Okay, great. Thank you. So just want to really give some folks actionable takeaways. What are some of the biggest mistakes that you see folks making in the fundraising process, besides coming with ridiculous valuations and no traction?
Not being clear on how much they're raising and what for. That can be very confusing. We had a conversation like that today. We were going in circles, like, how much are you raising? What are you going to do with it? So being really clear about your ask is a common practice. And I'll keep it short because we have 1 minute left.
Does that scare you when they don't have a really good model?
Yes, because I wonder what else they're not clear about, right? So do you have a business strategy? Have you thought through everything? If you haven't thought through your fundraising needs, and not just this round, tell me what the next round looks like. Tell me what the exit looks like. Tell me you've thought about the end and worked backwards. Then I know you're thinking like a strategic leader. If they don't have that, it makes me think they're missing something from a business strategy perspective. And it's like if you walk into a house and an open house and a cabinet is askew, you're wondering what else is broken. Right?
So when they come in and say they're looking to raise $1 to $5 million, that's not a good thing.
That is not a good thing.
I would actually sort of agree and disagree on that. So I think having a little bit of a range and being open about it and having a logic around the range and the use of funds is okay and fair. Obviously, 1 to 5 is probably too broad of a range. Do you want 1 or do you want 5? But it's like there's a lot of complexities right now. I think there's a lot of this stuff where we see entrepreneurs coming to us, telling us, okay, we're raising $1 million. It's like, what part of Series C, Series A investors did you not understand that we are? It takes me to my second pet peeve. People come through the door, they have no clue who we are. Even the firm, let alone me as a person, right? It's so simple to check out people nowadays. We have videos, we're talking all the time, we're in panels and whatever. So it's like, at least just 5 minutes. I'm not asking you to do that with all VC firms or whoever you're talking to. Approaching the VC firms and channels. My friend has written a great book about it, which I'm sure he'll tell us more about. But how do you approach? What are the right channels to get to people? Warm intros. How does that work? So just be prepared. I think would be as I would start, and you'd be shocked on how ill-prepared most startups are when they come and talk to us.
I fully agree with that, especially in green biz. There's a lot of people who are all green and no biz. And this is serious business now. We are not here to hug trees. We are not here to deal with 3 tons. We are here to have gigaton impact. And so if you don't come in with really serious numbers and a really serious business plan, also being a nice person. We're going to work with you for 7 to 12 years. This is someone you don't want to come in as a supplicant. You come in as an equal, but you also don't want to come in as an arrogant asshole. And there are people who make that mistake, and they should really consider not doing that.
I'd say one of the other things, too, that people often mistake in the startup world is working on your pitch, working on your presentation materials is not working on your business. And one of the big things that we run into is somebody says, here's all my stuff, and you say, this looks great. A lot of it's hypothetical. A lot of this is starting after the first check gets deployed. Do you have a business? And you would be amazed how many times the answer is no. So if you've got some strategic people that are going to be your customers, get those LOIs. If you've got team members, get an employment agreement in there. Even if you can't afford to pay them yet, defer that to whatever. Make sure you have a lot of outs. Get MOUs out with the right people. Have some business so that you have a data room. So you're not just saying, here's my deck, here's my plan, please fund me, and then we'll build it. It's like, well, that's just a guy with an idea, not a business.
I'm going to tell a super quick story. I introduced someone, I was in showbiz, and everybody's here familiar with Tim Rice. If you don't know who that is, he co-wrote a bunch of the Disney songs that you know and love, and that if you're a parent, you've heard on a loop for years. And I remember I happened to get to know him a little bit, and I introduced a friend of mine who gave him his demos. He said, "Can I send you demos?" And he very graciously said, "Of course." And he said, "It's just me on a guitar." And he started to doing it's just me, and I'm not really, supposed to be a woman's voice, and it's a different key. And Tim said, "Don't you think that maybe I, of all people, might know how to listen to a demo and imagine it with a 30-piece orchestra in a Broadway house with the right kind of voice? We know how to read a deck. If your deck or your website are too good, but your fundamentals aren't so good, something is off. So trust us that we know how to read it."
Go ahead.
Yeah. I really hate to disagree with you, Zoe, but I'm going to disagree on one of your tiny points. One of Zoe's points was, don't be an arrogant asshole. I agree with that. I do agree with that. But she did say, you said, be nice. And one of my workshops is secrets of VC. VCs do not fund entrepreneurs who are nice.
But you said that so nicely. I don't mean be a doormat.
I'm not looking for money, Zoe.
Nice is, I don't mean being a doormat. I mean being somebody who has integrity, who knows who they are, who has values, who stands for those values, and who believes in their business and won't get,
Okay, huzzah. Okay, all right.
But in a way that is fun and nice to be around.
With a high sense of urgency, right? Yep. And high confidence and conviction, and the ability to build a world-class team.
And it is a long-term relationship. I think that's a bit what Zoe's talking about. But it is salesmanship. This thing is not a science, right? It is salesmanship. It's the ability, and it's both ways. At some point, if the entrepreneur is a still entrepreneur, this is their third startup, but they've had 2 multi-billion-dollar exits. It's the other way around. It's the VC needs to sort of be like, do you want to work with us, please?
Right.
So salesmanship matters a lot. It matters both ways.
Well, can I play on the salesmanship angle? So wait, have you guys already heard me do my shtick on getting to wow? Have you already? You haven't heard the shtick on getting to wow? So my shtick on getting to wow is entrepreneurs, and this is one of the big mistakes. Entrepreneurs, they come to us and they're so excited about their product or their technology or whatever. They're so excited, and they're so excited about how many gigatons they're going to remove from the atmosphere. They keep describing their product and describing their technology and describing, their tech stack or whatever, and they don't get to the point in terms of how does that deliver value, right? And so they assume if I have a technology that sequesters carbon that I must be brilliant, right? No, right? So what you've got to do is, if you want to impress us up here, you've got to get us to get excited about what you're doing, and the way you get us excited is because you can articulate that you can deliver a unique and compelling value that nobody else can deliver. It's got to be compelling, though. It's got to be something that's going to make us say, wow, that's amazing. How do you do that, right? So it's salesmanship. It's the same thing you have to do with your customers. Your customers don't want you to describe your product. They want to know, how are they going to realize benefit? We don't invest in companies that build products. We invest in companies that deliver benefits. So what is the compelling benefit that you and only you can deliver to a target customer base?
Also, have a good answer to the question, why me and why now?
Yeah. One last question. I know it's the end, but one last question. And we can please be concise, otherwise we're going to incur the wrath of Rob. What are the 3 most important questions that an entrepreneur should ask a venture capitalist or an investor before they sign the term sheet? There's going to be an inordinate amount of due diligence on the entrepreneur, but what are the 3 most important questions they should ask or they should find out?
Well, I would say the critical one is, what value add can you bring to me? Can you give me examples? Can you introduce me to some references, companies that you have invested in that have gone well and have gone badly? But you can't ask that on a first call. I've had people asking me that on the first calls, like, I'm sorry, is this not a first date? So that absolutely does not work. So timing is very important for you to extract questions. We do something at Chamaeleon, which is everyone at the end of a call in our deal team asks the following question: do you have any questions for us? And we'll give you a bit of space. And we are actually, this is a day we're actually on the quality of your questions, right?
So yeah, so first of all, Roger, I think this is a great question to ask a VC panel, right? I think this is a great question to ask a VC panel. And generally, right, you know, every VC will say, we're a value-added investor, you know, and look at our portfolio, and here are 15 references, and, you know, look at all we've done. And yeah, they will do that. So, but to get a little bit more nitty-gritty and tactical, I would recommend that, again, probably not the first time you meet them, but core to understanding what VCs can do for you is, will you continue funding me in the next round? And I'll tell you, I mean, I've had some great VCs. As an entrepreneur, I did 4 companies. I had some great VCs. And what I learned is that great VCs, they've got good Rolodexes, they're smart, they've got good connections. The most important value a VC can provide for you is to make sure you don't run out of money. And if they're in it for a once and done, okay, you can take their money, but if you can find someone who is in it for multiple rounds, who that's the way they play and that's their commitment to you, that's so much more important than I got a great Rolodex. Right?
By the way, the right answer to Bill's question is no, I cannot guarantee that I'll keep giving you money, even if I have $1 billion under management. Because the hidden truth in venture capital is every investment decision, even a follow-on, is an investment decision. Right. So if some VC tells you, I will guarantee I'll fund you for another 2 or 3 rounds, they are BSing you.
Unless
I would
they're your
agree.
dad.
They are BSing you.
I would agree with your point, but I want to hear, if I'm an entrepreneur, I want to hear the way the VC answers that question.
Yeah.
And
What factors
if the VC gets all defensive on you, if the VC gets all defensive on you, then, you know, that's the exact same mirror image of how we react to the way entrepreneurs respond to questions. If the entrepreneur gets all defensive when we ask questions, we get all negative on you, right? If the VC gets all, I'm not pointing to Nuno here.
Okay, we got to rein Bill in.
Those two,
so Conor, Zoe.
I'm going to be really fast.
3 things.
Those 2 questions are correct. The other question is, if everything goes perfectly, where do you see this company in 2 years, 5 years, 10 years? Is there a vision aligned with yours? Because if it's not, and they're just going to force you to sell it or do something that you really don't believe in, they're going to strangle your darling, and you're going to be sad. So make sure that you're going in the same direction.
And please get these kinds of answers before you got the term sheet and the pen in your hand.
Yeah.
You know, those very last questions should be like, how are we going to work together?
Are you free Thursday
and
to
where's
celebrate?
The part? Yeah, where are we going to celebrate this, right?
Yeah, I see where things go badly with clients and VCs is a misalignment of vision. And I think it's so important to have that conversation, even if it may be a hard conversation, and that often comes out on the drag-along rights. So if there's a misalignment on the vision for the exit strategy or timing, it can be really painful. So, are we out of time?
Well, let's hear for the panel.
Thank you to the panel.
Well, panel, you exceeded expectations. You also exceeded the time limit. That was beyond brilliant, compelling, dynamic, entertaining, and scintillating, but it's also beyond the time limit. So that being said, it's time for audience participation. If you have a question for the panel, come right up to the mic stand, ask away. It's not a pitch event, though, so do not deliver a pitch or a thinly disguised pitch. If you do, you have to deal with Joe, our bouncer. So first question, step right up. And we can form a line here. We want to get as many questions in as possible. Go for it.
Hi, my question is for Bill. Your firm, Pegasus Ventures, works, your specialization is connecting startups with corporate partners. Yeah. What is the process, especially when you're so small? How does that work?
Yeah, so the big value add for Pegasus is that most corporations don't know how to work with startups. And that's, and so having us sort of as what we hope to be the trusted intermediary, helping our corporate partner assess the venture viability of a startup company and helping the startup company with a potential collaboration with the corporation is hopefully the win-win-win. So the startup company wins because we facilitate reasonable interactions with the corporation. We help the corporation with their innovation strategy and with the deployment of their capital toward advancing their innovation strategy. And we then therefore invest in companies that are going to be good venture capital investments and good strategic investments, which generates more money for Pegasus.
I just want to, jump in. If there's anyone who's not able to stand in this line and who wants to ask a question, can we get a mic to them, just if there's anyone who's less able, less mobile?
Yes, I will. Thank you.
Hey, this is Sonia. I just had a question for anyone who wants to take it. How have you seen the funding rounds change their size? I mean, at one point, at its peak, we saw news of pre-seed rounds being raised to the tune of $7 million, $10 million. Going from an era where seed rounds were like 50,000, 100,000, 200,000 to pre-seed rounds being tens of millions of dollars also. How have you seen that change now, and what are the realistic expectations for tech industry in general?
I'd say in the Bay Area, 1.5 to 2 million pre-seed, 3 to 5 seed, 7.5, 10 million or above Series A, and I'm giving you a prescriptive answer, which is BS, right? Because honestly, I mean, it depends. We've seen Series A 20 million, 30 million. The US is normally 1 order of magnitude more or less, not 1 order of magnitude, but it's slightly below, right? So a Series seed in Europe would normally be 2, 3 million, and here it's probably 5 million, 3 to 5 million round. It's a little bit horses for courses, right? Because it's the value chain. If you look at angel investors, friends and family, they can sort of get you to 1.5 to 2 million, and you have a lot of micro funds now in the Bay Area and in the US in general. So that sort of gets you to the 1.5 to 2 million. Then once you start getting people like us, that $1 to $5 million checks, then you get to Series C, right? 3 to 5 million, and from there. So I don't think there's any fast rules. Unfortunately, we've bastardized the whole system. It was A, B, C, it was beautiful, and then it was seed, and then it was pre-seed, and then it's friends and family, and then it's angel. But order of magnitude, I would say that's what I'm seeing today in terms of certainly Bay Area in the US, pre-seed 1.5 to 2, and 3 to 5 for seed, and 7.5, 10 million or above for A. Yeah.
I'd also say the uses of the proceeds factor in a lot more to the size of the round. So if you're going around in whether it's an A or a pre-seed or a seed or whatever it is, people are going to say, okay, you're raising money, that's great. What are you doing with it? And no one wants to see a bunch of money sitting in the bank for an unknown period of time. No one wants to see the entire round be deployed in the company in the first 4 months. So everyone's sort of saying like, okay, how much cash are you really raising? Does this make sense? What's the next vine that you're going to be swinging on, and does that make sense? And so everyone's sort of looking at getting across the bridge and making sure they're on a bridge and not a pier. And that's, I think what I would advise is just be very clear about what your uses of capital really are and your capital needs, and maybe talk to a few people about that so that you have a really solid plan.
Are you guys open to convertibles in the seed stage, so the less than 5 million, like safes?
I can't tell you how much we hate safes. I can't. I mean, we do actually. We'll do convertibles, but I just can't tell you how much we hate.
I think we've done one convertible thus far, and we hate convertibles for a variety of reasons, which I won't go into detail because it would take me too long. But it's sort of the difference. The analogy is dating versus marriage. We believe in price rounds. We believe in marriage. That's basically it.
So
does that mean you believe in polygamy?
No, we don't. We actually, when we focus on a company, we invest in them. That's the only company we're going to invest in that space, right? We're not going to invest in conflicting companies. Yeah, it's.
I think a convertible preferred note does serve a useful purpose. The nice thing that a convertible preferred does, as opposed to a safe, is it sort of outlines the rules of engagement, particularly around that conversion. So the reason why everyone hates safes is it's basically an IOU, and there's a potential for a lot of missed connections to result in litigation when those things are converting. So I think a convertible preferred note is great, especially if you're investing something that might have great IP or great assets that you can be a senior secured on, and maybe if things don't work out, make another run at it with a different team. But the not that that's vulture capital.
Yeah.
No, so I guess the question is, the answer is, like, it's much better to just say, all right, let's cut the BS, let's do a priced round, here's what our position in the company's gonna be, this is the value add, and here's the next jump. Sometimes for certain companies that might be between rounds, convertible.
Just
preferred.
sometimes with a $1 million investment, it doesn't really make sense to do a price round on NVCA docs.
We just
But-
want to see the round is in sight, and
Yeah.
we're talking about one now where it's like, okay, you don't raise your A by the end of the year, it's going to automatically convert to your seed price, and then we'll.
I would say I can get the price of an NVCA Series A docs round to a value which is almost the same as a safe, so that's not a big deal. So the whole argument of pricing by the lawyers is not a big deal. From my perspective, at least the lawyers I work with, I guess they're great. And then the second thing I would say is the whole notion of the safe in terms of conversion. Honestly, at the end of the day, there is an implied valuation in your notes, right? There is a cap in there somewhere, and there's a discount. So, I just did a deal. This is with a tier 1 VC firm who had come into a note. We went in a month after they just put money into the note, and we said, we'd like to lead with a larger check. We'd like to take a board seat. What do you guys think? The tier 1 VC firm partner knew me. They said, great stuff. By the way, we're willing to waive our 20% discount on the note. So we'll all go into the priced with no discount. It's a tier 1 VC firm, right? So stuff happens like that. I think people do see the value sometimes in having one committed partner that is willing to step up and go on the board and really help the company, right?
Yeah, sort of a side note, because our model is different. When we find a company that we really like, that there's a really interesting fit with one of our corporate partners, and the timing is now, we don't want to fight, particularly in the current environment when there's so many companies who have blown expectations in terms of valuation. We're happy to do a note. We're happy to note, put a cap on it. Usually it's the last round price. And we'll let the dust settle on whoever wants to come in and fight the valuation battle. But we want to get going with doing a partnership and working with the company.
All right, hi, I'm Katka. I have a question, like a very technical one from the founder's perspective. When you're putting together your list of your dream investors, how would you think about building the momentum, how you approach which VC, what is the best order? Also, I'm interested to hear if you see something you like, but it's not in your investment thesis or in your vertical, do you pass on deals to other people? Yeah. So is there value in impressing someone who is not your investor target one?
There is no such thing as a wasted audition. If it's not a fit for us, but it's fabulous, yeah, we will. I've sent people to 8 or 10 other folks if I think they're that good.
I think that one thing that, and actually I'm glad that you're bringing this up because it does kind of dovetail nicely into a thought of common mistakes. When you're running a funding process, make sure you're running a process. So it's not an endless networking thing. Identify who's actively investing in your space. Make sure that you have maybe 200-300 different venture firms that like the business that you're in, the stage that you're at, put together materials so that you can send them something to look at that doesn't require them signing an NDA. Ask them to sign an NDA, get more details. Don't be surprised if they don't. You have to send a SIM across without anything signed. But what you have to realize is reach out to everybody. Send out an email to the people that are active in your space. They'll respond to you, talk to everyone. If they say, oh, this isn't right, this is too small a deal, say, oh, do you have anybody that invests in this deal size? This isn't right, I only invest in this space as opposed to that. Oh, who do you know that might be interested? But a lot of founders will sort of buddy up to one VC, put all their eggs in that basket. It doesn't go well, then go to another one. And realize everyone's playing the long game here. So we've got so many deals that we're trying to close. If someone's not ready because they are asking for too high a valuation, we'll say, cool, let's go get lunch. Let's talk about that next, whatever the next benchmark is. And so it's really on you to make sure that it's a process. So get aggressive, send stuff out to everyone. Don't worry about having too many people that want to come in and not enough room. That would be a good problem to have. But definitely do that. And suggest closing dates. Hey, we really want to get some indication of interest from you that you're participating in this round by next Friday or by the Friday after, just so that they start saying, oh, well, our investment committee meets here and not there. And
Ask process from VCs. We're always very clear about our process and how it works. You can ask relatively early, actually. I don't think that's one of the questions you should leave to much later. It is a process, it's a sales process. You need to get your pitch clean. And so the likelihood your pitch will be really good when you first pitch to VCs is almost zero, right? And so the first VCs you should pitch to maybe are your tier 2 preferences. You're still interested in getting their feedback. They're interesting. Maybe they will come in. Maybe they won't even leave. But maybe they're not your top tier guys that you really want to go after. Run it iteratively, right? I used to have a team that they would run it, German guys that are based here in the Bay Area. They would run it 5 at a time, right? 5 VCs at a time, which I think is maybe a little bit conservative. But, and they realized, for example, one issue, which is tonality. I don't know if you're from here or not, but American entrepreneurs have a huge advantage if they've grown up in the country. They've been marketing and selling since they were kids. And so the level of noise they create in a room when they come and pitch to a VC is very high. And if you don't have that level of noise, you need to have something else. These guys would slap each other. I would not recommend that. The CTO and CEO would slap each other in the face before getting into a meeting and say awesome 5 times each. And they got actually 3 term sheets in that round. It was their second round when they went out and they got 3 term sheets from very well-known firms. Again, I don't recommend it. The other thing I would just say is one thing to be aware with VCs is, let's say you come to me and pitch me and I say, not interested. Are you willing to introduce me to someone else? Maybe I am because I really like something you're saying. The first question the other VC is going to ask is, are you investing or not? And if you're not investing, why? So it might be negative bias. Maybe you don't want to actually explore that. And VCs, we share deal flow between each other. I'm a managing partner. I find I get a lot of deal flow from principals or below. I get very little deal flow from other managing general partners at other firms. Don't know why. So that's another thing maybe to take into account. We do share deal flow. We get a lot of stuff. We're friendly for the most. I think the industry is probably seen as too competitive, more than it actually is. People do share deals. But just be careful with those negative biases and whether that really is going to be conveyed in the right way or not. I'm not sure that's the right angle. It might be better to have a really warm intro to the VC by an entrepreneur they know or someone that they respect as an angel or whatever.
And the other thing too, just dovetailing on that, is everyone's so busy. You may not want to rely on them to make that intro anyway, but you could be like, oh, do you know a fund that this would be a better fit? And they like, oh yeah, ABC fund. And you're like, cool. Who there should I talk to? So-and-so, great. And then you just send them an email. And that way, it's sort of like, hey,
it's still referring to the person who you have in.
Well, you don't even have to really refer to that, because like one of the things to remember is like VCs are constantly raising money and constantly deploying money. So we got an assembly line going, and if you got a deal that fits our thing, we're going to look at it. So it's just getting that piece on the assembly line.
Hi, my name is Hong. I have a question regarding NDA and disclosure. Of course, the first meetings are non-NDA. At what point can I ask for NDA and start disclosing more information? I mean, of course, if I start saying, what market I'm after, the account list, and what I'm hitting, wow, that's basically telling everything already, right?
He started out saying that you shouldn't demand an NDA until there's a term sheet on the table, because the term sheet always includes a confidentiality clause. And then he intimated that maybe that is too late. And that's where I'm going, which is to say we're not going to issue a term sheet until we do deep due diligence. And so if you have the kind of company that has a lot of proprietary information, we're gonna dig into your pipeline. We're gonna certainly dig into your financials. We're gonna dig into your technology, and so a lot of that. Once you're at the data room level, so for us, it's kind of the data room level is the point at which we will sign an NDA. And that's, and we don't sign an NDA trivially, so it's a pretty good signal. It's a pretty good signal if we want to get into your data room and we're willing to sign an NDA. That's a reasonably good signal, I think, for most.
It depends also on the stage, right? If we're very early stage, some people here are a little bit more mid stage.
I'm going to contradict you now. We do not sign NDAs.
Period.
And some VCs will not. Our lawyers advise us not to. We need to be able to share. I would say meter out your information carefully. Once you're at the data room level, we're serious. We're not wasting our time, out of curiosity. We're not going to waste our time. We're serious. And we do keep the information confidential. It's our reputation on the line as well, but we need to be able to discuss it unencumbered. And then, in the term sheet, there's that confidentiality section.
We're similar to
some will
Jennifer,
sign,
yeah.
my point being, some will sign, some will not sign.
We're similar to Jennifer. We rarely sign. It would have to be like a trade thing, very deep IP stuff. Yeah.
And so again, back, our model is we're going to bring a corporate partner to the table, and our partners want to sign an NDA. So our corporate partners want to know that we're covered under a non-disclosure agreement because we don't want you coming. There's a whole bunch of legal reasons why we actually want to sign an NDA once we get into a data room and we bring a corporate partner to the table. So you're going to hear contradictory advice because of different models that we have.
I think one other thing to realize is that when it comes to the business model, when it comes to the tech, when it comes to the overview, that all should be shared without an NDA. You should be able to speak to what you're developing, what you're building without an NDA, and even a lot of the stuff in the data room, corporate structural things, and that's practically public information anyway. The only time where an NDA may become a deal breaker is when you have a tech stack that has something so sensitive in it that you really feel like you can't disclose it without having some protections. And like you heard, that may be a deal breaker for some that say, hey, we're not going to sign an NDA. We're going to keep your stuff, But the reality is, we will sometimes sign an NDA, but we will never do it until we're preparing a term sheet and have to tick this last box off. So just be prepared to share it. And a common mistake that people make is they think their stuff is confidential when it's not.
Can I ask a second question?
Maybe just
Hi, I'm Sherwin. I'm building a cybersecurity company. My question is kind of basic. In the last year, 2023, what is the company you invested in that you're most excited about? I'd like to hear from
We
each
love
of the
them
panelists.
all equally. We have no favorite. It's like asking if I have a favorite kid.
You never asked that from a VC. Babies.
Fair enough.
They're all individuals, and we love them all for different reasons. We have a portfolio to spread risk, and also, you want stuff that's not identical to each other. So the point is that they're all unique, and therefore we do sincerely love them all in their own way.
But the reality is that most VCs are most excited about their next investment.
Oh, he's giving it away.
Hi, I'm Rishikesh. Just wanted to get a little insight into the criteria you guys use for founders, especially for the Climate Tech Zoe. Should there be single founder, multiple founder, technical founder, non-technical founder? What is the criteria that you guys use?
There should be the right number of founders for that company to achieve the thing that it's trying to achieve. Obviously, like I said, if they're all green and no biz, there are a lot of people who are like a wonderful mad scientist, and they will come in and they'll tell you about an amazing membrane that does things with hydrogen and but I would generally like to see somebody like that paired up with someone who's like the spreadsheet guy or gal, who is coming in and really is the business person. And I think we all know that a lot of very successful sort of mad scientist types have been very, every jobs needs their Wozniak. There's often, so it'll be a matter of the chemistry of a team is more important. So I wouldn't say that there's, climate's weird because a lot of it is so new that there's not like a typical founder, which is great because it's an opportunity for more diverse founders, so that there's a little less of an idea of what somebody looks like who's going to be successful. But honestly, if the idea is brilliant and we think the team is right, then we're happy.
One of the things too to just look out for is when you see a deck that has a 20-person advisory board and a 10-person executive team, it's that's not a real situation. We want to know who's working in the company. We want to know that it has the right fit. Technical founders is technically a lot of bullshit sometimes. So just be careful about that. If you have somebody that is a technical professional, make sure that they are an actual founder and that they're collaborating. Stay away from the urge to appoint people to serve as a member of the executive team that's not delivering day-to-day value in the business.
I'll make this quick. So when is the right time to connect to a VC? Is this good? Okay. When is the right time to connect to a VC? Ideally when it's like when you have your business ready and traction, or it's more like some people say it's like dating. You know, you go build relationship with a VC and stuff, and then both of you decide if you want to go get long-term relationship.
It's a lot easier to ask someone for money if they've known you for a while, but obviously you don't want to waste their time. So, you know, from my point of view, I would love to see, you know, if I have a friend who tells me, oh, I'm starting a thing, like, you know, you want to be with the ones where you have the long, deep relationships because there's trust, and then things like NDAs get a lot easier. So if you can meet them in environments where it's, you know, you're not jumping the gun, but generally speaking, you know, before you're going to ask someone for money is a better time to meet them.
So I use, when I started as a VC, you know, we were looking to reach the globe, and so our attitude was, it's never too early to talk to a VC. I told you that. I'm sorry. Forget. But what I learned, you know, was that it's not the right time to talk to a VC until you've got something that's going to make them fall in love. So you've got to get, you know, you've got to have something that's going to make this impression on them that makes them want to meet with you again. So it doesn't necessarily mean you have to be funded that moment, but you've got to have something that's going to make them say, ooh, this person is special. I really want to keep track of her. I really want to stay in touch with her. And so you've got to figure out what's going to get them to fall in love with you now. You can't just say, I'm in climate tech, and I know you're in climate tech, so someday you're going to want to invest in me, right?
Let's be green friends.
I think one of the things that I would say is make sure you have the business, make sure you're ready to really go out and onboard millions of dollars into the business, and then go out and say, hey, start networking and say, hey, look, I'm about to kick off a fundraising process for my thing. I'd love to get your input on it. Let's go get lunch and try to have those meetings. And by that time, you should be doing things like working on your pitch so that you're going to be presenting well. You're going to have the secret sauce, so you're going to be able to engage your VC connections. But I would tie it to sort of that pre-stage of okay, we're going to run a process.
Great, thank you.
Hi, last question tonight. I'm Michael Takamoto. We have a product that's about 95 MVP. Okay, the question is, how important is the software patent to things?
I would say rarely important. Rarely, unless it's a very deep tech piece.
Okay.
Rarely important.
All right,
we
thank
are
you.
looking for moats. Technology moats normally, very rarely, come through the form of patents. I think that's been my experience, at least in the spaces that I play more actively. I have done, obviously, as I said, deep tech, frontier tech. In some cases, that makes a huge difference, at least for defensibility, so that one of the larger players can't come after you, right? But offensive, I mean, if VCs were funding you for offensive IP stuff, then we would not be in this business.
Got it. Thank you.
All right, we have time for one quick question and a quick answer. Bill.
Hi, my name is Hannah. I have startup in Gen AI field. So my last and quick question is about if companies like mine, if they come to you and ask you to give us valuation, is it very common, or we should have our valuation with us?
There's the Harvard Law School, the Harvard Negotiation Project started at Harvard Law School, and there's the Stanford Graduate School of Business Negotiation stuff, and they are opposed in their views on that regarding asymmetry of information when negotiating. And then there's the guy, the FBI guy, the never split the difference guy, who's just like, let's kill everyone. My philosophical view is that startups should tell you, the VC should tell you what valuation they would come at. The lead VC, okay? My team never asks valuation unless you've already signed a term sheet, and therefore we're coming into a round that is already led by someone else. That's the instructions that my team has.
I agree, although We will try to get to some understanding of what your expectations are, because I don't want to waste my time if you're looking for a 50x multiple on your revenue, right? So, but the market should set the valuation in general, to his point. But we still want to know, and if somebody can't kind of answer that, we'll try to backfill. What was your last round, and what dilution are you looking for to try to get there? If they're too evasive, it's kind of uncomfortable.
All right, well, let's give it up for our panel. Let's give it up for Roger, our awesome moderator. Let's hear it for Hana House and Procopio and all our sponsors. Let's hear it for our event team and our video team. Let's hear it for Joe, our bouncer. And let's hear it for you, the audience, for showing up. Let's hear it for me. So stick around, network, socialize, and connect. You can get selfies with the panel, ideally in front of an Idea to IPO sign. We need to leave the building at 9:30 p.m. There is an after party. Here are the choices once again. The Rosewood, it's Thursday night. The Patio, Pizza My Heart. And the decision is, it's Pizza My Heart. It's just down the street. So see you at the after party. Thanks for coming. See you next time.